A brief question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. It is now my pleasure to introduce your host, Brendan Frey of ICR. Please go ahead.
Thank you for joining Purple Innovation's first quarter 2021 earnings call. A copy of our earnings press release is available on the investor relations section of Purple's website at www.purple.com. I would like to remind you that certain statements we will make in this presentation are forward-looking statements. These forward-looking statements reflect Purple Innovation's judgment and analysis only as of today, and actual results may differ materially from current expectations based on a number of factors affecting the company's business. Accordingly, you should not place undue reliance on these forward-looking statements. For a more thorough discussion of the risks and uncertainties associated with the forward-looking statements to be made in this conference call and webcast, we refer you to the disclaimer regarding forward-looking statements included in our first quarter 2021 earnings release, which was furnished to the SEC today on Form 8-K, as well as our filings with the SEC referenced in that disclaimer. We do not undertake any obligation to update or alter any forward-looking statements, whether as a result of new information, future events, or otherwise. Today's presentation will include references to non-GAAP financial measures such as EBITDA, adjusted net income, and adjusted earnings per share. A reconciliation of these non-GAAP financial measures to the most comparable GAAP financial measures is available within the earnings release, which can be found on our website. With that, I'll turn the call over to Joe Megibow.
Thank you and good morning, everyone. With me on the call today is John Legg, our Chief Operating Officer, and Craig Phillips, our Chief Financial Officer. Following our prepared remarks, we'll be happy to take your questions. As you saw from our earnings release issued earlier this morning, 2021 is off to a very good start. First quarter revenue and adjusted EBITDA were up significantly on a year-over-year basis and both meaningfully exceeded our expectations. Given our recent performance, we are pleased to be raising full-year guidance, which Craig will walk through momentarily. The year began with strong demand in our digital channel, and as the quarter progressed, we experienced a sharp acceleration in our wholesale business. The product and marketing strategies we are executing, which showcase the premium nature of the Purple brand and our differentiated comfort technologies, along with our recent capacity expansion, combined with improving traffic at brick-and-mortar retail and the impact on consumer spending from government stimulus, all contributed to our outperformance. A few of the financial highlights from Q1 include net revenue increasing 52% to $186 million, gross margins improving 340 basis points, operating income increasing 125% to $16.9 million, and adjusted EBITDA more than doubling to $22.8 million. Looking at our performance in more detail, I'll begin with our DTC business. DTC revenue increased 54.8% to $125 million. We kicked the post-holiday selling season off with a strong first week of January and carried that momentum into February before accelerating during an even stronger President's Day. Momentum remained high through the rest of the quarter, and we saw a peak when the March stimulus payments were received. Our average order value with a mattress increased 6% year over year, driven by a combination of product mix and pricing increases. Moving on to our Purple brand showrooms, they continue to grow in size and importance to the DTC business. We entered Q1 with 9 showrooms, compared with only 4 in the year-ago period. We signed several new leases during the quarter, 3 of which opened in April, and we remain on track to add between 20 and 25 this year. All locations are performing very well, with our older showrooms now exceeding pre-pandemic sales volume, and as to our newest locations, they have scaled faster than any of our original locations. We recently introduced a new store design that looks amazing, with elevated presentation and an opportunity to tell the full brand and technology story across our complete assortment. Looking at our product performance, our innovative mattresses continue to lead our business, and within mattress, demand continues to be strongest for our Hybrid Premier product line, underscoring the progress we have made advancing the consumer recognition of the premium benefits of the Purple products. As to our non-mattress products, our disruptive pillows had a banner year and were up nearly double in Q1 over the same period last year. helped in part by the success we have experienced launching Harmony with our wholesale partners. Seat cushions nearly doubled from the prior year as we capitalized on the momentum that started early in the pandemic and have continued to learn and improve our product merchandising and marketing. We launched a new adjustable base that we're really excited about and is already seeing triple the attach rate that our previous model received, reflecting the right mix of style, functionality, ease of shipment, and price point. Our other bedding products also experienced substantial growth similar to pillows and seat cushions in the first quarter. We are very pleased with our progress in driving non-mattress products, led with pillows and seat cushions as standalone products, and continue to sell the majority to new-to-file Purple customers who have not yet purchased a mattress. We remain bullish on the CRM opportunities this is creating. And as to engaging new customers, on April 1st, we launched the Purple Squishy, our miniature sample mattress and pillow, as an actual purchasable product, each one shipped in its own adorable Matchbox container, and in unit volume, we are selling at similar levels as pillows or seat cushions. Not surprising to our brand, we have seen fan videos with more than 10 million views in total featuring the new Squishy. Which brings us to marketing. Our brand evolution continues to make progress as we continue to focus on the differentiation of our product with clear benefits at the center of the campaigns. We have also seen significant performance from both testimonial formats and a focus on Made in USA, which is a genuine source of pride for us. Although we are early in our capabilities, we are seeing meaningful improvement in CRM and repeat customers as we continue to increase the size of our database and find effective ways to directly engage, led by both our maturing email capabilities and success with direct mailers. This has resulted in an increase of repeat orders of approximately 75% versus the same period last year. From a promotional activity perspective, we leaned heavily into President's Day, a typically large mattress holiday, and also played on the aspect of sleep related to daylight savings, both of which were successful campaigns. Finally, for product and marketing, I'm thrilled to report on our recent announcement of our partnership with Dr. Michael Bruce as our new Chief Sleep Advisor and first advisory board member. Dr. Bruce will be overseeing academic research regarding the efficacy of our products, as well as assisting in research on new product development we have underway. As Dr. Bruce stated, our hyperelastic polymer is like nothing he has seen in all his years as a sleep researcher and clinician. We look forward to his help with formally demonstrating and documenting what we and our customers have known for years. Switching now to wholesale, our wholesale revenue increased 48% to $62 million, our best performance to date, and continued evidence of our ability to compete side by side with traditional players. As I mentioned earlier, the pace of wholesale sales picked up as we moved through the quarter, with sell-through strongest in March. Our performance in existing doors, same-store sales, has returned to pre-pandemic levels consistent with Q1 last year, with most growth then coming from new doors added. Also encouraging is that newer accounts such as Love & Furniture have been meeting expectations, and Sleep Country in Canada is starting to reopen with only 40% of locations closed as of this month. In addition to our strong brand and product momentum, our wholesale performance also benefited from some external factors. Specifically, store traffic has continued to improve as more of the U.S. gets vaccinated, shifting a portion of the volume online gained during the pandemic back to physical retail. More stores are open compared with recent quarters, especially in Canada. And similar to DTC, we have seen spikes in wholesale sell-through correlated with government stimulus checks. And as of mid-March, we are starting to see easier comparisons due to store closures last year. The strong momentum in wholesale has carried over into the second quarter so far. In Q2, we are seeing higher sell-through at existing doors and anticipate that trend going forward as we lean into merchandising and advertising strategies, and have therefore adjusted the number of new doors we plan to add in 2021. We previously expected to add over 1,500 doors in 2021. However, by refocusing our resources onto maximizing existing door productivity first, we now expect to open between 800 and 900 total doors in 2021, which both achieves our stated net revenue goals and creates even more opportunity for the future. Moving on to production, as I stated last quarter, we anticipate 2021 being our first year where we've deliberately built excess manufacturing capacity and we are well underway in this regard. Purple South in McDonough, Georgia, is in production, making Purple Grid, assembling mattresses, as well as making both seat cushions and pillows. Max 8, the first machine at Purple South, has been in full production mode since February. In May, we brought Max 9 online, and Max 10 and Max 11 are on schedule and will follow later this year. These 4 machines are expected to increase our mattress output by over 65% by the end of 2021, which will further expand as we bring on Max 12 and 13 next year. And with our current capacity, we are already producing record levels of mattresses in April. We are also completing our work on our entirely new next generation Max machine, which is already able to make Purple Grid in limited capacity and which we anticipate coming online in Purple South later this year as well. We are very pleased with the start to our mattress, pillow, and seat cushion manufacturing, assembly, and fulfillment activities in Georgia. In order to provide us with greater flexibility around our future plans for this location, which could include additional production for a fast-growing pillow and seat cushion business, potential space for additional Mattress Max machines, and regional expansion of our customer care operations, we recently took the opportunity to amend our lease and increase the size of the facility by an additional approximately 300,000 square feet. This expansion will allow us to take advantage of economies of scale as we increase our presence on the East Coast, which along with our facilities in Utah provide us with a great foundation to meet the growing demand for our brand and products, drive efficiencies in our cost structure, and better serve our consumers and wholesale customers. We also continue to invest in quality and operational improvements in all of our Max machines and assembly lines and have recently introduced significant advancements in semi-autonomous raw materials feeds, mattress assembly, and fulfillment. These efforts continue to lower our labor costs per unit and increase our overall capacity. I'll now turn it over to Craig, who will review the financials and our outlook in more detail.
Thanks, Joe. As Joe outlined, 2021 is off to a strong start from both a revenue and adjusted profitability standpoint. For the 3 months ended March 31, 2021, net revenue was $186.4 million, up 52.3% compared to $122.4 million in the prior year period. The revenue increase was driven by strong demand for our entire product portfolio across all channels. For the quarter, DTC channel net revenue increased 54.8% year over year, and wholesale channel net revenue grew 47.7%. Gross profit dollars were $87.5 million during the first quarter of 2021, compared to $53.2 million during the same period in 2020, with gross margin at 46.9% versus 43.5% in the first quarter of 2020. This gross margin increase of 340 basis points year over year can be attributed primarily to channel mix shift towards DTC and fixed cost leverage on higher revenue and production volume. DTC net revenue comprised approximately 67% of net revenue for the quarter, compared with approximately 66% in the same quarter last year. Operating expenses were 37.9% of net revenue in the first quarter of 2021 versus 37.3% in the prior year period. The 60 basis point increase was driven primarily by additional administrative costs to support continued accelerated growth, partially offset by efficiencies in marketing and selling costs. Marketing and sales expense as a percentage of net revenue decreased to 29.2% compared with 30% last year due to leverage on higher net revenue and more efficient marketing spend, partially offset by additional marketing spend to increase brand awareness and the addition of company-owned showrooms. For the first quarter, we reported operating income of $16.9 million compared to $7.5 million in the first quarter of 2020, an increase of 125.3%. Net income for the quarter was $20.9 million compared to net income of $28 million in the year-ago period. As previously disclosed, we recently determined that our outstanding warrants should be accounted for as liabilities and recorded at fair value on the date of the transaction and subsequently remeasured to fair value at each reporting date. For the 3 months ended March 31, 2021 and 2020, we recognized non-cash gains of $9.1 million and $21.6 million respectively associated with the change in fair value of warrant liabilities. Excluding the impact of the company's tax receivable agreement and the change in fair value of the warrant liability items, adjusted net income was $12 million or 17 cents per diluted share based on an adjusted weighted average diluted share count of 68.6 million, compared to adjusted net income of $4.6 million or 8 cents per diluted share, based on an adjusted weighted average diluted share count of 58.3 million. Adjusted net income has been adjusted to reflect an estimated effective income tax rate of 26.4% for the current year period and 25.4% for the comparable prior year period. EBITDA for the quarter was $27.8 million compared to $30.8 million in the first quarter of 2020. Adjusted EBITDA, which excludes certain non-cash and other items that we do not consider in the evaluation of our ongoing performance as detailed in today's earnings release, was $22.8 million compared to $10.6 million in the same quarter last year, an increase of 115%. Moving to our balance sheet, as of March 31, 2021, the company had cash and cash equivalents of $103.8 million compared to $123 million at December 31, 2020. The decrease was driven primarily by capital expenditures of $12.3 million, primarily related to manufacturing capacity expansion and showroom expansion, and net cash used in operating activities of $9.4 million. Net inventories totaled $63.3 million at March 31, 2021, compared with $65.7 million at December 31, 2020. Turning to our guidance. Based on first quarter results, we are raising our 2021 outlook. We now expect full year 2021 net revenue to be between $860 million and $900 million, up from its previous range of $840 million to $880 million. The new range represents an increase of 33% to 39% over 2020 results. Considering our first quarter results, adjusted EBITDA is now expected to be between $95 million and $105 million, up from its previous range of $90 million to $100 million. This includes consideration for recent trends indicating an even greater channel mix shift toward wholesale in the second quarter, which could put additional pressure on current margin rates. For the second quarter of 2021, we expect net revenue to be between $200 million to $210 million and adjusted EBITDA between $21 million and $25 million. We continue to expect capital expenditures for 2021 to be in the range of $45 to $50 million, consisting primarily of approximately $20 million for the continued build-out of the Georgia manufacturing facility and $19 million related to the acceleration of showroom expansion, as well as expansion of wholesale displays and additional equipment for production and innovation facilities. I'll now turn it back to Joe for his closing comments.
Thanks, Craig. As you can hear, we remain very optimistic about 2021. I previously stated that this would be an investment year, and I'm very pleased with the significant progress we've made and anticipate continued investment in building out the team, investment in manufacturing and supply chain capacity, investment in the e-commerce platform, investment in contact center capabilities, investment in showroom expansion, and investment in innovation with not only a focus on product innovation, but renewed focus on manufacturing and materials innovations as well. It's worth reminding that the overwhelming majority of our revenue comes from manufacturing equipment of our own design using materials of our own invention. We are very excited about what all of that will bring over the next few years. As to the balance of 2021, as Craig stated, we have raised our full year guidance, reflecting the overperformance in Q1. We have learned to adapt to a seemingly endless run of unpredictable events, and I have continual confidence in our team's ability to successfully react and, where possible, arbitrage opportunity. With that in mind, we remain confident in the balance of the year as originally planned. The one change we see possible would be mix shift from DTC to wholesale if we find additional wholesale opportunity that our growing capacity can support, and which could create gross margin pressure. We would still view this positively toward our long-term strategy of taking share, which has significant long-term benefits. And long-term is what gets us most excited, with our many anticipated innovative premium product expansions, geographic and channel expansions, and strengthening brand, all of which remain at the core of our growth strategy. In support of this, we anticipate hosting a virtual investor day by the end of June to discuss our multi-year strategy and operating goals. At this time, we will open up the call to questions.
At this time, we will be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. We also ask for each participant to limit themselves to only one question and one follow-up question to allow others a chance to ask their question. One moment, please, while we pull for questions. Our first question is from Atul Maheswari with UBS. Please proceed with your question.
Good morning. Thanks a lot for taking my question. You did not call out supply chain and foam issues as impacting you in the first quarter. So A, was that an issue at all? And did you leave some sales on the table because of those issues? And if it wasn't an issue, how were you able to sidestep some of those pressure points that others in the industry called out?
Yeah, hi. Thanks for the question. Certainly, no one in the industry has been completely immune from some of the supply chain challenges. One advantage we have is our dependence on foam is less than I suspect some other manufacturers or sellers are, as our best selling and the majority of our units are coil-based cores with our purple grid on top, which is no foam at all. So some of it is just the design of our mattress. Our dependency on foam has been less, and that has helped. I'd say we have been working with multiple suppliers and have been really leaning hard into a dual or multi-source strategy to augment our traditional suppliers. It's been touch and go. I think we've been right at the razor's edge, but so far we've been able to stay just slightly ahead of our needs.
Got it. That's helpful. And then as my follow-up, on your expectation now of adding only 800 to 900 wholesale doors versus 1,500 plus earlier, does that add more risk to your guidance given your reliance on smaller number of doors to fulfill your revenue expectations? So what is the thought process behind it? I'm assuming the contribution margin on these stores is going to be higher, but I'd love to get your thoughts on it. Thank you.
Yeah, so we said this last quarter as well. There's nothing magical in our minds on any specific number of stores. Really, it's about hitting the revenue goals that we anticipate around wholesale and in meeting that consumer demand. The most efficient opportunity we have is to sell everything we can in the doors we have, and we've been recently emboldened by our ability to increase same-store sales and see growth in the doors we have, which also then increases the value of every door and every future door that we would go into. So really, it's just a matter of, with the resources we have, maximizing what we can get out of our existing stores first, and then augmenting that with growth in newer stores. It's, recognizing it's more expensive to open additional doors, and there's a ramp, and there's more of a delay in getting the full value in opening new doors, which is just the nature of going into anything new. So it's going to be a balanced mix of both. It's just we had started the year with sort of a preconceived notion of what every individual door could contribute, and then you build out from there. We're discovering we actually do have more opportunity in the doors we're in, and that's very exciting.
Got it. And if I can squeeze in one last one. On the gross margin, I know you called out DTC mix as a tailwind, but really direct-to-consumer was largely in line with the first quarter of last year, and then you probably also had some costs associated with the new Atlanta facility. So maybe can you provide some more details on what drove the gross margin expansion in the first quarter and how much of that is sustainable versus one time? Thank you.
Sure. Craig, you want to take that?
Yeah, there were a couple of factors. We actually, when we compare it to the prior year, some of our freight costs were actually improved as a percentage of revenue. And the fact that we exceeded what our expectations were and what we planned for on revenue, because of the additional volume, we were able to leverage a lot of our fixed costs. So that's primarily what drove our better margins.
And our next question is from Our next question is from Keith Hughes with Truist. Please proceed with your question.
Thank you. Could you give us any sort of feel in terms of growth differences between price points in the quarter? Was it shifted more to the higher end or lower end of your offering?
Sure. You're talking about mix shift that we've had across our product line?
Yes.
Yeah, so we are increasing, and this has been a multi-quarter trend, really a multi-year trend, to go up market. So more and more of our overall share is our hybrids, and we're continuing to grow, especially with our hybrid premiers. So yeah, I'd say we're becoming both less of a foam core mattress company on the mattress side, and we continue to lean upward.
And back to the door openings you talked about earlier, a lower number this year. Is that due to some customers you thought you were going to get you didn't, or slower offerings that or fewer doors at existing customers or new customers you're opening up?
Yeah, and again, customer here, I assume you mean is wholesale partners versus end customers. As we're not seeing any waning in demand whatsoever. So there's nothing we're slowing here. It's really just a shift in focus. We have a finite number of resources, and it's a matter of where we invest our energies. So there is still an enormous amount of demand for our product out there. There's still an enormous amount of demand from the retailers that are out there. It's just spinning up a large retail arrangement takes many, many months and a lot of work, and typically involves piloting in a few stores, proving it out, getting the training done, and then ramping up as we prove our we're very big believers in sort of earning our keep, proving our ability to execute on the floor, which we always do. So we're not slowing that down at all. It's just, again, we're recognizing we're leaving money on the table that we can go after now in the doors we were in, and we are investing there first, as it's the most efficient way for us to expand our wholesale revenue. And again, as I said in the prior questions, it just increases the overall value of every individual door, which is a very great place to be.
Okay, thank you.
And our next question is from Matt Koranda with Roth Capital Partners. Please proceed with your question.
Hey guys, thanks. Just on the DTC side in the quarter and going forward, I just wanted to see if you could maybe discuss a little bit more about your own showroom contribution to revenue in the DTC channel this quarter. I wanted to get a sense for how you see that playing out as you add doors over the rest of the year. Remind us again, I think I caught in the commentary still about 25 doors expected to be added, so the cadence of that would be helpful as well for the rest of the year.
Yeah, so we're at about 11 doors right now, and as we said in the prepared remarks, then the new design and the newer doors are outpacing the original doors, both in terms of their trend as well as their sort of ramp speed, how quickly they become fully productive. So we're increasingly emboldened with the success of our showrooms and our ability to execute on growth there. Given the number of doors we are anticipating opening balance of the year, it's obviously going to be a pace that's picking up. I mean, we're going to be likely, call it, within a month or two, we'll be opening roughly a door a week, just to hit those numbers by the end of the year. And our pipeline on leases signed or leases nearly ready to go, and locations we're looking at are fully on track with meeting those goals. So we feel very, very good about that. All in, it's still a relatively small piece, single-digit percentages of overall DTC, which is, given the store count, it's going to be a little while, a few quarters before it starts becoming any meaningful amount. But it is contributing and growing. And I'd also, we don't, it tends to get forgotten in this, but in addition to our showroom doors and DTC, we've also been continuing to invest substantially in our contact center, We are still believers of called human-assisted selling, which you obviously get in a showroom setting where you can directly engage with our employees. But our ability to do that virtually through phone and chat continues to be one of the highest growth engines in this business, and is really going to be the second channel behind DTC, way ahead of showrooms in our ability to grow, and again, it's continuing to be our fastest growing channel.
Great, that's helpful, Joe. And then just on the gross margins, it seems like embedded in your outlook, we may expect gross margins have sort of peaked in Q1, but it looks like seasonally, if we look at the historical patterns, Q1 is relatively lower than the rest of the quarters. And it sounds like you're alluding to just the mix shift is the main explanatory variable there in terms of why we're probably not going to see increased gross margins for the remainder of the year. But maybe just wanted to see if you could discuss that interplay a little bit, Craig. That'd be helpful.
Yeah, I would say that you're right. That is what we were trying to convey, is that as we continue to grow the wholesale side of the business, there will be pressure on margin, and we have seen the trend of wholesale continuing to improve. And first quarter typically is one of the lowest margin quarters for the year. So, what you're saying is true, and that is the trend that we're seeing.
But
is that? Sorry, go ahead.
No, I want to be clear that we, our positioning that we have a lot of opportunity for gross margin expansion remains. I mentioned in the prepared remarks our significant investment in operational improvements, where we're both driving more volume out of the equipment we have, reducing labor costs per unit, reducing waste. I mean, we have significant investments we continue to make in our operational efficiencies. I would say we're not even mid-innings there. We're still in early innings there. So as you said, certainly mix shift is a very big contributor to overall margin, as wholesale margins are dramatically lower than our own channels. There's also the overhead of the investment. I mean, we've taken on 300,000 square feet more in outside Atlanta, which we're continuing to build out. So again, it's an investment year, but I want to be clear that our opportunity to expand margins is still very real, and under all of this investment, we're seeing those benefits.
And our next question is from Bobby Griffin with Raymond James. Please proceed with your question.
Good morning, buddy. Thank you for taking my questions. Craig, Joe, I just wanted to maybe touch briefly on raw materials and pricing and what you guys are kind of doing on the pricing side and what's embedded for pricing through the rest of this year, 2021.
Hey, Bobby. Raw materials, as with everyone in the industry, we are seeing some inflation in pricing, which we're certainly hoping is peaking out here. Again, we're finding ways also to, through our sourcing strategy, be as efficient as we can in our cost of goods. We did just raise prices a couple of weeks ago, and as we've gone through this in prior quarters, recall that because of our wholesale contracts, it can take 30 to 60 days before we see the full benefit of those price changes flow through. But we did raise prices again. I believe this is the fourth time we've done this now successfully. So far, early data shows that it's yielding the results we anticipated. So we'll continue to look at it. We clearly have some opportunity to raise prices. We've talked about we're going to continue to offer models that allow us to have higher price points intrinsically as the year progresses. But I'd say it's fairly straightforward. Craig, anything you'd like to add?
Yeah, I was just going to say, they're because of the raw materials we're using, a lot of the products that we buy from vendors. Excuse me. We're trying to find other vendors where we can potentially manage those costs a little better. and just expand the supplier base as well.
Okay, I appreciate it. And then, Joe, I also want to circle back on just kind of the better productivity you're seeing inside wholesale on a per door basis. I mean, I think the slowing down the door growth is actually a meaningful positive when you kind of dive into what it's implying you're getting now on your same store doors. So can you maybe touch on what you're hearing from retailers of why you're getting that acceleration, better marketing, any of the things you're doing to kind of push there? Is it a factor that you guys just had better supply because you weren't relying on phone? Anything there to help us understand, what's driving this good new productivity or better productivity inside your same stores? Because that's a very positive long-term trend here.
Yeah, no, you're right, and I'm thank you for picking that up. That is the point we're trying to make. This is a newer trend for us that we're leaning into hard right now. So, I mean, we're figuring it out as we go. I'd say it's a mix of a number of things. So, first of all, there was just opportunity to expand. Coming out of COVID, we've had partners who I don't think had fully realized the potential of our product. Raymore and Flanagan had launched with us in February of last year, right before the pandemic hit, and now that everything's coming back, they've got renewed enthusiasm. We only had 2 beds on the floor. There's opportunity for us to get 3 or 4, and those kinds of things are happening. Similar with our early work with Rooms to Go, where we had started with only a couple of beds on the floor. We're now getting to we're earning the right to get more square footage on the floor, and that translates into sales. So some of it is rounding out our fleet and making sure that we're getting the opportunity to sell the full assortment. But we also, many of our stores are on displays from multiple years ago. So reinvesting in our presentation, I'd say what we've learned through our own showroom strategy and how to present our product better and the sales techniques. And as we have invested in building out our field sales team, which I've mentioned in prior quarters has been very, very light relative to industry averages. We are also learning how to be a better partner to our retailers and improve our selling on the floor and improve our presentation on the floor. So you put it all together, and it means, and not surprisingly, as a young company, we by no means had achieved our maximum potential in the doors we're in, and we're continuing to find ways to do that. Sorry, I forgot one other thing is accessories. We also rolled out our Harmony pillow in most of our wholesale partner doors now, and leaning into accessories. And again, part of our strategy is our accessories aren't just units to throw onto a mattress. They really stand on their own, and having unique bespoke product that actually stands on its own is kind of a new game for many of our wholesale partners who haven't been as good with accessories. And it's also opened up new possibilities to get brand penetration and engage with customers in these retail settings.
Thank you. That's helpful. And then I guess just one quick modeling question. The $2 million of Georgia facility production cost that was kind of called out in the adjusted EBITDA walk, did that mostly hit gross margin or cost of goods sold? And is that, a decent run rate for us to use for the next couple quarters?
Yeah, that is mostly in gross margin, I believe. And going forward, I wouldn't continue to use $2 million because we are now up and running. The facility opened in the first quarter, so that will likely continue to decline.
Okay. I appreciate it. Thank you, Craig. Best of luck, guys. Thank you so much.
Thanks.
Thanks, Bobby.
And our next question is from Susan Anderson with B. Riley FBR. Please proceed with your question.
Hi, good morning. Nice job on the quarter. I was wondering if you could talk about maybe the marketing spend. I think you mentioned that you were more efficient with it in the first quarter. Maybe if you can give some color around that. Was that just shifting to more digital? And then also your expectations for the rest of the year. I think first quarter you also said was higher year over year.
Yeah, hi, Susan. Marketing, yes, we got some leverage in Q1, and last year, as we've reported many times, we had some incredible opportunity to arbitrage marketing. I'd say marketing expenses are getting more marketing platforms are getting more expensive. There's more money coming in. It's getting more competitive, and we're starting to see things climb back up to levels pre-pandemic, and in some cases even higher as discretionary spend continues to open up. So, I'd say we had opportunity in Q1 both to continue to arbitrage without the investment and competition we're seeing right now, and let's not forget there was the shot in the economy, stimulus money that came in last quarter as well. We leaned hard into that, as we always do, and that was very productive for us. But that does mean, when there's extra money out there to spend, we work a little less hard overall to capture those customers. So, the team continues to mature. We continue to find ways to expand our addressable market and gain leverage. I've mentioned many times our increasing investment into lifetime value and CRM, which lowers our cost of acquisition at the transaction level. But it is getting more expensive out there and more competitive, and that is going to create a headwind that we're going to have to deal with moving forward.
Got it. Okay, that's helpful. And then I was wondering if you could talk about the performance of the non-mattress products versus mattresses, and then also any new products you have rolling out for the rest of the year.
Yeah, so non-mattress continues to outpace mattress, which is terrific, and I'll just keep saying over and over because it's true. It's not just on the strength of our brand. It's not just because we've got a purple tag sewn on. I mean, these are amazing products that stand on their own, and we could have a healthy business just selling these non-mattress products. So they're great products that we continue to learn how to market, merchandise, and sell, and even more so than our mattress line, have some real low-hanging fruit opportunity for line extensions and new product expansions and new channels for that matter. The channel opportunity in these non-mattress are far greater than where mattresses are sold, which we're already starting to lean into. I'll give you an example. Our seat cushions, we continue to expand in places where consumers would buy them. Through a distribution partner, we are now in all of Love's truck stops around the country, and that's quickly become one of our top retail locations for seat cushions. It's just amazing to see these kinds of opportunities bubble up. As to new product, we've hinted many times we have some amazing new product in the labs that we are developing and working on, products that are, we're emboldened by the success we're making as they're very real, with some significant advancements in what we have to offer. As with all things innovation, they'll be ready when they're ready. We expect some of this, as we've been saying for a while, to be launched by the end of the year, and a lot more over the years to come.
Great. That sounds great. Thanks so much. Good luck the rest of the year.
Thank you.
And our next question is from Brian Nagel with Oppenheimer. Please proceed with your question.
Hi, good morning. First off,
good morning, Brian.
Congrats on a nice start to the year. Great start. So first question I had, just with regard to, Craig and Joe, you both mentioned stimulus in the benefits of stimulus in your prepared comments. So the question I have is, if I remember correctly, back when the pandemic stimulus started, a year ago, I thought you had made the point that you didn't really see the benefit or direct benefit in your business. So I guess one question I have is, if I understand now, you did see a benefit. So that's one. Then how should we think about, or maybe what are you seeing with regard to sustainability of that? So because now you're essentially we're halfway through the second quarter. Obviously, the guidance you laid out here implies very much a continuation of the strong trends. I mean, how much of that is stimulus driven, or if at all, and how long do you think this could last?
Yeah, no, it's so you're remembering correctly some of the conversation we had mid-year last year, and I'd say really that was a question of correlation versus causation. We saw very high correlation. We asked our customers in direct surveys, did stimulus impact your decision to buy with us? And we got a resounding no. But the correlation, nevertheless, was very, very tight. And what I'd say is it's been harder for us to continue to tease out, hardcore causation. But nevertheless, we are seeing very, very tight correlation that anytime there is an increase, a sudden increase in discretionary spend, we see equal and now predictable increases in what flows through. So at some level, you stop asking the question and you just recognize it is correlated, and we do see flow through. As to the year, when we built our annual operating plan, we didn't have stimulus expectations in there, and that's part of why we're saying that we got some benefit. I mean, I think we executed very well in Q1, and I think our ability to lean into these moments in time and capture the customer that appears, we continue to be good at. But we're effectively saying we got some overperformance in Q1 for a number of reasons, stimulus being one of them. It's difficult for us to predict any of that moving forward. So we're basically saying, let's put that overperformance in the bank, and we continue to remain very bullish on what was otherwise an aggressive plan for the balance of the year.
Got it. That's really helpful. And then the second question, or the follow-up question I had, just with regard to new products. I know we talked about this in the past, but any update there with the new, particularly the higher-end type products you plan to launch here?
Yeah, again, we don't spend a lot of time talking about unreleased product, as I've been consistent on that. We had said we were going to launch some significant addition to our line by the end of the year. We still believe that is in the realm of possibility. As with any significant endeavor on the innovation side, you learn as you go. These are multi-year initiatives that that are about invention and discovery, and we're learning a lot. And as I said, we're very emboldened with how far we've come and what we've learned. At this point, again, I do anticipate we'll be able to launch more premium product that represents the outcome of some significant investment of ours by the end of the year. Beyond that, we have nothing to say at this time.
Great. I appreciate it. Congrats again. Thank you.
Sure. Thank you.
Our next question is from Brad Thomas with KeyBanc Capital Markets. Please proceed with your question.
Hi, good morning. Nice start to the year here. I had a couple follow-ups on gross margin, if I could. The results really impressive here. Understanding that channel has been a really important factor in how gross margin has played out in recent quarters. I guess putting that aside, can you talk about some of the underlying puts and takes and how we should think about those going forward?
Yeah, are you referring to puts and takes as a result of channel?
I'm saying if we ignore channel and we just think about manufacturing costs, price, things like that.
Yeah.
How to think about puts and takes on gross margin. Yep.
Yeah, so some of the puts and takes, well, we've already talked about, the raw materials when it comes to foam and coil and the price differences we've been seeing recently. That's one piece. Another is freight out. With as much traffic as there is in freight, that can vary sometimes widely. Others are, as we continue to build out Atlanta and increase the production there, we're going to start getting more leverage on those fixed costs in that facility. At Grantsville, as well, as we continue to improve manufacturing process and gain efficiencies out of that, those are certainly tailwinds.
Okay. All right. That's helpful, Craig. And just thinking about, again, I know that in 2Q you're up against a much tougher gross margin comparison with what happened to D2C. But on a sequential basis, it seems like maybe the quarter could be sort of similar to what you just saw in 1Q from a mix standpoint. Your revenue guidance obviously points to even more revenues than what you just did in 1Q. So how should we think about how that affects gross margin sequentially? I mean, does it need to step down a lot from where it just was, or can it be in the range of where you just posted for 1Q?
Yeah, I know you said let's put channel mix aside. I mean, our what we've proven over the last couple of years is our ability to expand wholesale quickly is much more fluid than our ability to just suddenly grow DTC. DTC tends to be a curve. You invest, you get the flywheel going, you grow. What we had been doing pre-pandemic, and obviously in the pandemic, we had a sudden externality that drove massive increase in DTC, seemingly overnight. But I mean, that otherwise never happens. How we had historically been doing it, and you followed us a while, so you remember, is we'd add some capacity, we'd immediately put all that incremental capacity to work in wholesale as DTC would ramp up, and as DTC would catch up, by then we're adding more capacity, and we would continue to have sort of this back and forth step function of taking advantage of capacity by significant wholesale expansion as the DTC growth happens, more on a traditional curve. And I think we're going to be getting more back to that. John Legg and team have been just relentlessly building out capacity. We're tickled how we haven't had many questions on this, but I mean we're tickled how on track we are, and on top of not only the grid and iron expansion of more Max machines and more injection molding machines, the efficiency gains we're getting are remarkable. I mean, we are putting so much into semi-automation and efficiencies, and it even gets into raw material costs. Our ability to feed raw materials into the machines with larger bulk buys and less human involvement and more consistency and less waste is driving quality and yield improvements. So we're getting all those benefits, which means we're getting the capacity available, which means we have opportunity to lean harder into wholesale, which we can move very quickly. So that's the wild card. If we really can get some significant movement in wholesale, which we are seeing more and more opportunity for, those are going to have more immediate impact on gross margins in the short term. And it's just balancing short term and long term here as we make sure we keep the overall ratio consistent over time. But in any given quarter, we could have significant swings.
Gotcha. That's really helpful context, Joe. Thank you. If I could add one more follow-up just around that wholesale opportunity that seems so exciting and seems like you're seeing some really encouraging data points from. When you look across your partner base and look at what the offering is, the number of beds they have per store, how they sell the accessories or adjustable bases that they may be utilizing, how far along are you in identifying sort of best practices, and can you talk about the opportunity to speak more with those retail partners and continue to point them towards how to maximize their Purple volume?
Yeah, we're still, and you've been following us a while. You remember we were, I don't know how to, I think the business term is we were an awful partner to our early retailers when we began this. We didn't know what we were doing. We didn't know what we didn't know. And there's been a lot of learning and growth on all sides as we've learned to be a good supplier to our retail partners and learned how to do this better and better. We're competing side by side with institutional players who've been doing this for decades, and I assure you, they are noticing us now. So we're seeing more increased direct competition. Some of it has been fortifying the team. We've got some significant new hires that are coming on board as we bring in some top shelf leadership out of industry to help us navigate these contracts and the operations in the field. And we're continuing to build out the team, which is still a very, very thin team right now, with experienced, talented people. So I think there's a lot of opportunity in front of us. By no means would I suggest that we're great at this. And that's a very positive thing. I mean, that means there is still a lot of opportunity in front of us as we continue to learn and optimize.
And our next question is from Jeremy Hamblin with Craig-Hallum. Please proceed with your question.
Thanks, and I'll add my congratulations on the strong execution and results. I want to come back to wholesale doors for a second. I might have missed this, but I think you said you ended last year at a little over 2,200 wholesale doors. How many did you add in Q1? Roughly how many do you think you might add in Q2? And then it kind of as a follow-up to that, the limiting factor on, 800 to 900 wholesale doors added versus the 1,500 that you might have expected earlier this year. Is that capacity constraint or some other, reason why you wouldn't add more doors now as the brand is growing?
Sure. The numbers are noisy, in large part because of what's happened at Sleep Country Canada. We, at the end of last year, nearly there's around I think 275, 280 doors that they've got. Most of them had closed down by the end of the year as the latest waves of COVID hit across Canada, and Ontario province, continues to be mostly closed down. So for much of Q1, I think about 60% of the doors were closed. I think at this point they're down to about only 40% are closed as of now. So despite adding doors, the doors we have not been consistently performing, and and many of them, especially with Sleep Country, were shut down. I believe last quarter we added, call it less than 50. So modest door count increase. Although again, some of the doors that were closed were opening back up, and we'll continue to see more of those doors open back up. It has not been constrained by capacity or anything else. A lot of the retailers have been getting themselves refocused as business starts to come back. And again, these opening these doors at this point, and we're leaning towards Sleep Country type deals where these are full fleet, hundreds of doors type contracts. It takes time. I mean, it's just these are long negotiations with these partners to get it right, and then the training and rollout across the potentially hundreds of doors. So that's all in play. And this is exactly what we had guided to. It was one of the reasons we were a little more backloaded in the year, is we had said we did not anticipate significant opening in Q1. We were going to start to see some opening ramp up in Q2, and then really by Q3 is where we see the bulk of the door openings occur. And it's really just timed to business cycles, and really nothing more than that.
So embedded within that response, then, does that mean that 2022 could look like that's also a year with fairly significant door growth, given that, clearly the consumer is demanding Purple products. And I know there's, in terms of inventory turns, it takes some time to gain slots, especially for the first time, but then to add slots, which sounds like what's happening now. Is this something where, you could see 800 or 900 more doors added next year simply because the consumer is demanding it?
Yeah, the very last point you make is the most important one. This is how do we meet consumer demand and meet this addressable market that is still predominantly a brick and mortar category and a predominantly offline category. And again, we view ourselves first and foremost not as an internet player, a DTC player, but as a manufacturer of disruptive, premium, differentiated mattresses, and we want to get those in the hands of as many consumers as we can. So it really, we don't believe that we're going to need to be, deeply penetrated in wholesale, because we are showing ability to sell direct through a combination of our online capability, our own showrooms, and increasingly our contact center. And we've said what we're looking for is more of that 70-30 split of owned retail and wholesale. There is headroom there. So yes, I think the idea that there could be hundreds of doors more into next year is absolutely in the realm of possibility. But ultimately, I do think we're going to hit a point of equilibrium, and I think that does then start to decay as we get to maybe that 2,500 or 3,000 door count or somewhere around there, where we're able to meet consumer demand regardless of their purchase preference, but still manage a great owned relationship as well.
Okay, and then just as a follow-up on the gross margins, so mix was 34% in Q1 last year. It was 33% wholesale this year. I think Craig called out a couple of $1 million in, startup investment costs that had drag on your gross margins, and yet you still delivered, 47% gross margin. It would seem like that's almost like your baseline on a go-forward basis. Understanding, but is there something that we're missing in terms of, like, what's the maximum percent of revenues that you could see wholesale accounting for in any of the quarters? Like, you have had quarters where it was above 40%, but for the most part, it sounds like you're calling out 70-30 split. Maybe it's 65-35 some quarters. Will the mix get much higher than where it is now?
Well, and again, it's we're going to leverage all the capacity we have and lean as hard as we can into whatever we can grow. I'd flash back to the days before we ever knew the pandemic was going to happen. Our original plan that we were guiding to, call it, nearly 5 quarters ago now into 2020, actually was built around some substantial wholesale expansion, where we were talking about wholesale getting back into the mid to high 40% of total net revenue as the capacity we were building out, especially with our new facility in Purple South in Georgia, that was the fastest path to growth, the fastest path to consumer penetration, as, again, DTC built up. Now, it turned out the opposite happened. Wholesale, fell down as everything closed down last year, and we were presented with unexpected and unprecedented opportunity to substantially grow DTC. But I think we're getting back into the world we were in pre-pandemic, where there's a lot of addressable markets. There's a lot of consumer demand that we can go after efficiently and quickly through wholesale that we anticipate going after. And that could mean, not over the long haul, but on a quarter-by-quarter basis, it is possible that we could find ourselves in the 40s again on percentage of total net revenue, depending on the timing and how quickly the ramp goes with some of the wholesale expansion we're anticipating.
And our next question is from Seth Basham with Wedbush Securities. Please proceed with your question.
Thanks a lot, and good morning. My question is around the performance within the mattress category at existing doors of your largest and oldest wholesale customers. Could you give us some color on how you're performing there, if you're still gaining share?
Yeah, and good morning. Share is harder for us to calculate, as some of our largest and oldest customers are not public companies, and we don't always get perfect information. What I can say is we are still seeing growth, and recently meaningful growth, and that's encouraging. Whether our growth is faster or slower than their growth, it's harder for us to tease out. I think we're probably close to growing comparably. So I'm not sure we're actually gaining share right now, but I do think we are helping to support the overall growth in the business. So yeah, I think it's healthy, and we continue to see opportunity to expand, and we intend to continue to expand.
Got it. And if you add in accessories, including pillows, to the product set, do you think that you're more meaningfully growing share within your largest and oldest customers?
Yeah, so some of our earliest customers were very focused on mattress, not on accessories, and they view that as an opportunity for themselves as well. So our early success, especially with our Harmony pillow, has been very positive. And yes, I think that gives us opportunity to increase share. And I think our early performance has exceeded everyone's expectations. It's too early for us to project too far out with that yet, but we're very pleased with the early performance, and we see tremendous opportunity there.
Got it. As it relates to your production capacity being up 65% at year-end on a projected basis, when you build out the additional 300,000 square feet that you recently signed a lease for, where will your production capacity be up to by the end of 2022?
Yeah, we haven't fully built out the plan for that yet. We had an opportunity to take contiguous space at the facility we were already at that, and we, as we had said last quarter, we were already searching for our next location, our third location. And as we started to do the math, we realized there were opportunities for economies of scale on the manufacturing side that we could take advantage of by co-locating that additional expansion where we already were in Georgia. And we had other needs as well. Our growing contact center, which again is a significant percentage of our overall DTC business. We're out of space in our facilities in Utah, and we're looking for something on the East Coast anyway. So, this created opportunities for a number of benefits as we anticipate co-locating a fairly sizable owned contact center at this facility as well. So we're still building out the plan. And, as to the mix of Max machines versus injection molding machines versus fulfillment and distribution versus things like contact centers, we just got a gift of a significant amount of square footage that we can appropriately lean into. But right now it's more opportunity than defined outcomes.
And our last question is from Curtis Nagle with Bank of America. Please proceed with your question.
Good morning. Thanks for taking my question. Maybe just could we talk a little bit more about productivity, run rates, that sort of thing, in terms of your own stores, existing versus new. I think, Joe, in the past, you'd sort of framed annual revenue contribution at something over $1 million a store. Could we dive a little bit more into kind of where things sit, for your stores?
Yeah, our showrooms, it's well north of that number, and we anticipate some significant expansion in the four-wall productivity. As I said in the prepared remarks, we're very pleased with the performance. The newer stores are outperforming the original stores, and the original stores are back to pre-pandemic levels, actually higher than pre-pandemic levels. They're modest capital investment to build out, call it mid six figures, and we anticipate a true ROIC and maybe call it a year or a little longer. So I mean, really efficient, really good economics. Pleased with the performance of those, well north of $1 million per store, as you said. And we see a lot of growth potential there.
Got it. And just to clarify, I think you just said that return on invested capital is roughly a year. And if that's the case, that is pretty good.
Yeah, a year, a little longer, depending on the door. But yeah, it's, call it, give or take, closer to the year mark than anything else.
Perfect. Awesome. All right. Well, good luck on the rest of the year, and thanks very much.
Thank you.
And we have reached the end of the question and answer session. And I'll now turn the call over to Joseph Megibow for closing remarks.
Great. Thank you so much. We are off to a terrific start this year. We are executing as planned and intend to continue to invest in our growth and capabilities throughout the balance of the year. Looking forward, we remain very optimistic, both near term and even more so as we look out over the next few years. Our investments in new products and capabilities continue to go very well, and we look forward to sharing more of the strategy soon. I want to personally thank our nearly 1,700 employees for their relentless commitment and unwavering belief in our mission and goals. To all of our customers, employees, and partners, stay healthy, be safe, and sleep well.
This concludes today's conference, and you may disconnect your line at this time. Thank you for your participation.